What if I told you I'd give you $10,000 if your bike gets stolen? Sounds like a fantastic deal, right? After all, most bikes cost far less than that. You might start thinking about all the ways you could upgrade to a better bike after the inevitable theft. In fact, you might even start parking your bike in increasingly dangerous neighborhoods, using flimsier locks, or forgetting to lock it all together. This seemingly generous offer creates a fascinating paradox. By trying to protect you from loss, I've actually encouraged you to take greater risks. The more I try to shield you from the consequences of bike theft, the more likely you are to engage in behavior that increases the chances of theft occurring. This peculiar phenomenon has a name in economics: moral hazard. It occurs when one party takes increased risks because someone else bears the cost of those risks. In fact, this same dynamic nearly brought down the entire global financial system in 2008. Major banks, believing they were too big to fail and would be bailed out by the government, took increasingly risky bets. According to MIT's Sloan School of Management, the resulting bailouts cost American taxpayers $498 billion, almost $500 billion, or approximately 3.5% of the United States' entire GDP in 2009. The story of moral hazard is a tale of good intentions gone wrong, of protection becoming permission, and of safety nets transforming into trampolines. It's also a story that continues to shape our world in ways both subtle and profound. From insurance fraud to banking crises, from healthcare costs to corporate bailouts, moral hazard lurks behind some of the most pressing economic challenges we face today. But to truly understand how this force shapes our world, we need to explore how it operates across different industries, examine its hidden costs, and uncover the clever ways societies try to combat it. Because in the end, moral hazard isn't just an abstract economic concept. It's a fundamental feature of human behavior that affects everything from your car insurance rates to the stability of the global financial system. Moral hazard isn't just some abstract concept hidden away in economics textbooks. It's playing out all around us, often in places we least expect. Let's look at some everyday examples that reveal this fascinating pattern of human behavior. Consider the all-you-can-eat buffet. When you pay a flat rate for unlimited food, something interesting happens to your behavior. According to studies of buffet dining patterns, customers tend to take 5% to 25% more food than they actually eat when facing no per-plate cost. Without the direct financial consequence of waste, many of us load up our plates with more than we need, creating a staggering amount of unnecessary food waste. The very structure of the buffet pricing model inadvertently encourages this wasteful behavior. Or think about phone insurance that offers unlimited screen repairs for a flat monthly fee. When people know they can get their screen fixed anytime for free, they often become remarkably casual about how they handle their $1,000 devices. That protective case you religiously used before? It might start seeming less necessary when you know any damage will be covered at no additional cost. Car rental insurance provides another perfect example. Research in driver behavior shows that people tend to take more risks when driving rental cars with full coverage compared to their own vehicles. That tight parking spot you'd never attempt in your own car? Suddenly, it seems worth a try when you know any scratches or dents won't come out of your pocket. The pattern becomes clear. When we're insulated from the consequences of our actions, our behavior changes, often dramatically. This is the essence of moral hazard, the separation of risk from responsibility. When one party can take risks while another party bears the costs, It creates a perverse incentive structure that can lead to increasingly risky behavior. Think of it as a kind of economic physics. Just as nature abhors a vacuum, human behavior shifts when the natural connection between actions and consequences is broken. This separation doesn't just change individual decisions, it can reshape entire markets and industries. But here's where it gets really interesting. This same principle that makes you take an extra slice of pizza at the buffet also influenced how major banks behaved before the 2008 financial crisis. According to the Coalition Against Insurance Fraud, this disconnect between risk and responsibility costs the insurance industry billions each year, with fraud comprising about 10% of property casualty insurance losses. Understanding how moral hazard operates in these everyday situations helps us recognize its broader impact on society. Whether it's a buffet plate or a billion-dollar bank, the fundamental dynamic remains the same. When you disconnect actions from their natural consequences, behavior changes in predictable but often problematic ways. This insight is crucial because it helps us design better systems and policies that align incentives with desired outcomes, rather than accidentally encouraging risky or wasteful behavior. Meet Sarah, a small business owner who runs a local retail store. Like many entrepreneurs, she started her business with optimism and trust in her employees. But after experiencing several incidents of employee theft, she discovered firsthand how moral hazard can transform from an abstract concept into a very real financial burden. According to Embroker's research, the average loss from employee theft is $1,890 per incident, but the true cost runs much deeper. Sarah's insurance premiums increased. She had to invest in expensive security systems. She even found herself spending more time monitoring inventory instead of growing her business. While her insurance covered the direct losses, the indirect costs, both financial and personal, kept mounting. Sarah's story illustrates a crucial point about moral hazard. Its effects ripple far beyond the immediate participants. When employees know theft is covered by insurance, it can subtly shift their risk calculations. Research shows that businesses with full insurance coverage experience different patterns of employee behavior compared to those with partial coverage. According to industry studies, internal theft accounts for approximately 29% of retail shrink loss, creating a substantial burden that affects everyone involved in the business ecosystem. First, insurance companies raise premiums to cover increased claims. According to research by the Coalition Against Insurance Fraud, fraud and moral hazard comprise about 10% of property casualty insurance losses each year. These costs don't just disappear, they get passed on to every policyholder in the form of higher premiums. Second, businesses like Sarah's have to raise prices to cover their increased costs. Those security cameras, inventory systems, and higher insurance premiums, they all get factored into the price of goods. What started as individual acts of theft eventually becomes a hidden tax on every customer who walks through the door. Third, the entire industry has to adapt. Businesses implement increasingly sophisticated and expensive security measures. They modify their hiring practices. They change their operational procedures. Each of these adaptations comes with its own cost, both financial and social, creating a cycle of escalating expenses and declining trust. The most insidious aspect of this cycle is how it normalizes risk-taking behavior. When people see others getting away with theft or fraud, it can create a kind of moral contagion. The thinking shifts from, "This is wrong," to, "Everyone does it," to, "I'm just getting what's owed to me." McKinsey's research suggests that organizations with robust risk management and insurance programs spend an average of 15% more on prevention and security measures compared to their peers. While these investments help protect against losses, they represent a significant economic burden, one that ultimately gets distributed across society through higher prices and reduced economic efficiency. This is why moral hazard isn't just a problem for insurance companies or individual businesses. It's a collective challenge that affects everyone. Every fraudulent claim, every theft, every instance of unnecessary risk-taking adds another small weight to a system already straining under the accumulated cost of moral hazard. The solution isn't simple, but understanding how individual actions create systemic problems is the first step toward addressing them. When we recognize that moral hazard isn't just about individual behavior, but about the complex web of incentives and consequences that shape our economic system, we can begin to design better solutions that align individual interests with collective well-being. Remember our $10,000 bike lock experiment? Now imagine that instead of a bike, we're talking about the entire global financial system. Instead of $10,000, we're dealing with hundreds of billions of dollars. This isn't a hypothetical scenario. It's exactly what happened in the lead-up to the 2008 financial crisis. Major banks, operating under the belief they were too big to fail, engaged in increasingly risky behavior, knowing that government bailouts would protect them from the consequences of their actions. According to MIT's Sloan School of Management, when the house of cards finally collapsed, the resulting bailouts cost American taxpayers $498 billion, nearly $500 billion. The parallel to our bike lock experiment is striking. Just as the promise of a $10,000 payout might make you careless with your bike, the implicit promise of government bailouts made banks careless with their lending practices. They began making increasingly risky loans, packaging them into complex financial instruments, and trading them like poker chips in a high-stakes game where they couldn't lose, or so they thought. The too-big-to-fail mentality created a perfect storm of moral hazard. Banks knew they were considered essential to the economy's functioning, which meant the government couldn't let them collapse. This safety net didn't just protect them, it encouraged them to take even bigger risks. After all, if you know someone will catch you when you fall, why not climb higher? Research indicates that banks classified as too big to fail receive an implicit subsidy worth billions of dollars annually, simply because investors believe these institutions will be bailed out in a crisis. This subsidy, according to studies, effectively works out to a funding advantage of about $34 billion per year for the 18 largest U.S. banks, with more than $100 billion in assets. This scaling up of moral hazard, from personal to institutional level, reveals something crucial about risk in modern economies. When individuals take risks with their bikes or buffet plates, the consequences remain relatively contained. The implementation of Basel III capital requirements attempted to address this by requiring banks to hold more capital against their risky assets. However, the fundamental challenge remains. How do you create a financial system that's both stable enough to function and disciplined enough to avoid excessive risk-taking? Looking at the data, we can see how this plays out in real time. Banks subject to more intense supervision, exhibit less risky loan portfolios, and are less volatile, according to the Federal Reserve Bank of New York's research. The lesson here isn't just about banking. It's about how moral hazard scales up from individual decisions to systemic risks. What starts as a simple misalignment of incentives can, when multiplied across enough players and enough money, threaten the entire economic system. Our bike lock experiment, seemingly simple and contained, turns out to be a perfect miniature of one of the most significant economic challenges we face: how to protect against catastrophic failure without encouraging the very behavior that makes such failure more likely. So how do we solve the moral hazard problem without giving up the benefits of insurance and protection? The answer lies in carefully designed systems that balance security with accountability. Let's look at some ingenious solutions that are already working in the real world. Take insurance deductibles. They're not just arbitrary fees, but rather clever psychological tools. When you have to pay the first $500 of any car insurance claim, you suddenly become much more careful about where you park. Research shows this works. Data from Value Penguin indicates that increasing a deductible from $200 to $500 can reduce collision and comprehensive coverage costs by 15% to 30%. This reduction isn't just about savings. It reflects actual changes in driving behavior when people have skin in the game. Performance bonds offer another fascinating solution, particularly in the construction industry. These bonds act as financial guarantees that contractors will complete projects according to specifications. The results are impressive. Research indicates that contractors without a performance bond are almost 50% more likely to fail before completing a project. Reputation systems have emerged as a particularly elegant solution in the digital age. Take Airbnb, for example. Their scoring system has proven remarkably effective at reducing property damage incidents. Research shows that users can achieve a 70% accuracy rate in determining the quality of a profile, effectively crowdsourcing trust and accountability. Speaking of oversight, regulatory frameworks have evolved to become increasingly sophisticated in their approach to moral hazard. The Basel III capital requirements, implemented after the 2008 financial crisis, demonstrate this evolution. Under these rules, banks must maintain higher capital reserves against risky assets, effectively forcing them to put their own money at stake. The Federal Reserve Bank of New York's research shows that banks subject to more intense supervision exhibit less risky loan portfolios and reduced volatility without sacrificing profitability. Even buffet restaurants have found creative solutions to their moral hazard challenges. By implementing waste reduction techniques and strategic pricing models, some establishments have reduced food waste by 10 to 15%, according to studies by the scholars of sustenance. Simple changes like using smaller plates or implementing subtle penalties for excessive waste have proven remarkably effective. Healthcare provides perhaps the most complex testing ground for moral hazard solutions. Co-payments and deductibles help control unnecessary medical services, but they need to be carefully balanced against ensuring access to necessary care. Research shows that moral hazard accounts for about 53% of the difference in spending between the most and least generous health insurance plans, highlighting the importance of thoughtful plan design. The key insight from all these examples is that effective solutions don't eliminate risk. They redistribute it more effectively. Good systems ensure that everyone has just enough exposure to risk to encourage responsible behavior, while still providing meaningful protection against catastrophic losses. Think of it like a safety harness for rock climbing. The harness protects you from a fatal fall, but it doesn't eliminate all discomfort or minor scrapes. This creates the perfect balance. You're protected from disaster, but you still have every incentive to climb carefully. These solutions also reveal a crucial principle. The more precisely we can measure and assign risk, the better we can design systems to manage it. Modern technology and data analytics are making this increasingly possible, allowing for more nuanced and effective approaches to combating moral hazard while preserving the benefits of risk protection. As you go about your day, take a moment to consider these questions. How might moral hazard be affecting your own behavior in ways you haven't noticed? Think about the last time you had comprehensive insurance coverage for something. Did it change how carefully you treated that item? Did you take risks you might have avoided if you were fully responsible for any damages? What are 3 examples of moral hazard in modern technology companies? Consider how free storage backup might affect how carefully people preserve their data, or how unlimited return policies might influence purchasing decisions, or how platform safety guarantees might impact user behavior. If you were designing an insurance product, how would you protect against moral hazard while still providing meaningful coverage? What balance would you strike between protection and responsibility? What innovative mechanisms could you create to align policyholder interests with insurer interests? How might government bailouts during economic crises be redesigned to minimize moral hazard while still preventing systemic collapse? Is there a way to protect the economy without encouraging excessive risk-taking? What conditions or requirements could be attached to future bailouts to better align incentives? These aren't just theoretical questions. They're at the heart of many challenges we face in designing economic systems that work for everyone. The answers we choose will shape not just individual behavior, but the very structure of our financial and social institutions.